Hello everyone, welcome to EduTap and welcome to the Finance 360-degree sessions in which we cover the relevant finance current affairs and the RBI notifications which are important from your exam point of view. Okay, so in today's session, I have brought for you a very important RBI notification that has been recently released, and this is also in the news articles. So we have to discuss about the counter-cyclical capital buffer and what the RBI is saying regarding this counter-cyclical capital buffer. Now do tell me that I am clearly audible and visible or not. My voice is clear, right? So today we are going to discuss about what the RBI has recently said, as well as what is the framework for the counter-cyclical capital buffer. What does this actually mean? Okay. So now before starting with the topic for today, do subscribe to the YouTube channel so that you continuously keep getting such relevant videos, as well as join our Telegram channel where you will get the PDF of today's session. Okay, and the link for the Telegram channel is provided in the description box below. So let's get started. So the news article for today is that the Reserve Bank said it has decided against activating the counter-cyclical capital buffer as it is not needed in the present circumstances. So first we have to understand that what is this counter-cyclical capital buffer. Okay. So good morning and hello to everyone. Welcome to the session. Thank you for joining the session. So let's start with it. Okay. So the news article is that the Reserve Bank of India has decided not to activate the counter-cyclical capital buffer. So what is this counter-cyclical capital buffer that we have to discuss? Okay. First of all, I hope you remember that the banks, they have to keep the capital buffers. Okay. That is the capital to risk weighted asset ratio has to be maintained by the banks. Okay, that is the loans that they are giving. The banks are giving the loans. So those loans have some risk attached. Some loans have 100% of the risk. Some loans have 50% of the risk. Some loans have 20% of the risk. Some loans have 10% of the risk. So against the risk weighted assets. So the loans that the banks are giving, those are the assets of the banks, because the banks are earning the interest on those loans. So these are the loans are the assets of the bank. Now these loans, they have some risk attached. That is 10%, 20%, 30%, 40%, maybe 100% also. So against these risk weighted assets, the capital has to be maintained by the bank, so that if any of the loan is not coming back, then the bank can use these capital buffers to glide over the situation, to smoothly run its business, continue its business. Okay, so that is the idea, that the banks have to maintain the capital against the risk weighted assets. So this is known as the capital to risk weighted asset ratio, that is the CRAR, or it is also known as the capital adequacy ratio. That is, adequate capital has to be maintained by the banks. Now this CRAR is like the capital buffers that the bank is maintaining, that is the tier 1 capital as well as the tier 2 capital. Okay, tier 1 capital is the most liquid kind of capital, and in that tier 1 capital there is the common equity tier 1 capital. This is the most liquid kind of capital. So the tier 1 capital is the liquid capital that the banks can use easily. So tier 1 capital is the liquid capital, and in this tier 1 capital there is the category of the common equity tier 1 capital, that is the most liquid kind of capital, such as the undistributed reserves that the bank is keeping, the undistributed profits that the bank is keeping and such. So this is most liquid. Okay, then there is the AT1, that is the additional tier 1 capital. So this is the bonds that the bank is releasing. Okay, the tier 2 capital is actually the assets of the bank, that if the bank is failing down, then the bank can use this tier 2 capital, so it is not very liquid. Okay, so that is the tier 2. Now the capital buffer, it has to be maintained 9%. Okay, the banks have to maintain the capital buffers of 9%. That is, tier 1 has to be maintained in this, the CET1 has to be maintained 5.5%. AT1 has to be maintained 1.5%, tier 2 has to be maintained 2%. So that is 9% in total. Okay, this is the 9% in total. So that is the capital buffer that the banks have to keep. That is the CRAR. The banks have to keep 9% plus 2%, 2.5% of the capital conservation buffers have to be kept by the banks. The capital conservation buffers have to be kept by the bank. That is the additional, this is the additional kind of capital that the banks have to keep. Okay, so I hope you remember this, that the CRAR is 9% and the capital conservation buffer is 2.5%. So in total 11.5% of the capital the banks have to keep. Now what happens that there are sometimes circumstances where the banks are required to even keep higher of the capital than this 11.5%. That is the situation where the banks are keeping the counter-cyclical capital buffer. Okay, that is the counter-cyclical capital buffer. So the banks in the normal condition also, the banks have to maintain the capital to risk-weighted asset ratio. That is the basic of the capital buffers. Then the banks have to maintain the capital conservation buffer, that is 2.5%. And above than this, the banks in the extreme kind of situation, in some situations where there is the pressure that is coming, okay, the recessionary cycle might start, or there are the external pressures that are coming, then the Reserve Bank of India can activate this counter-cyclical capital buffer. That is like a superpower. That is, the banks will have to maintain even higher of the capital buffers. Okay, so that is the additional, the higher counter-cyclical capital buffers that the RBI can activate. So we are going to understand more about this, but the news article is that the Reserve Bank of India has said that right now it is not required to activate this counter-cyclical capital buffer. It is not needed in the present circumstances because the banks and the country, the economy as a whole is working well. Okay, so I hope till now it is clear. Yes, Purushottam, correct. It is like a shield. It is like a counter-cyclical capital buffer. It is like a shield to protect the country, to protect the banks from the pressures, from the additional pressures that are accumulating in the country, or the additional pressures that are coming from the outside. So till now, is it clear? Yes. So now coming to the framework. So till now, the news we have understood that the RBI has said that it is not required for now. What is the framework for this counter-cyclical capital buffer? So the framework on the counter-cyclical capital buffer was put in place by the Reserve Bank of India in terms of guidelines that were issued on February 5, 2015, wherein it was advised that the counter-cyclical capital buffers would be activated as and when circumstances warranted. Okay, as per the circumstances of the country, if it is required, then the counter-cyclical capital buffers will be initiated, and that the decision would normally be pre-announced by the Reserve Bank of India. Okay, so how many months, how many days before the announcement will happen, that also we will understand. So this is the news article that has been recently released. This is the press release that the Reserve Bank of India has released, that for now it has been decided based on the review and empirical analysis of the CCYB indicators that for now it is not required to activate the CCYB. Okay, it is not required to activate the counter-cyclical capital buffer for now. Okay, so coming to the framework, the internal working group of the Reserve Bank of India under the chairmanship of Shri B. Mahapatra had submitted the final report on the implementation of this counter-cyclical capital buffer in July 2014. Okay, and it came into force, the guidelines for the counter-cyclical capital buffer, it came into force from February 5, 2015. So remember one thing very clearly, that the report was submitted in 2014 July, but it came into force in 2015. The report made recommendations in areas such as indicators. Now, how do you know that the counter-cyclical capital buffer should be initiated, should be activated or not? Should the RBI see that, okay, do we have a good GDP or not? So what should be the indicators for deciding that the counter-cyclical capital buffer should be initiated or not? So there were the indicators that has been mentioned in this guidelines, as well as there are the thresholds that have been mentioned in the guidelines. All of this we are going to understand today. Okay, so the report made recommendations in areas such as what should be the indicators, what should be the thresholds for activating the buffer, lead time for announcement, and what should be the time for the announcement of the buffer. So the aim of this counter-cyclical capital buffer is twofold. Okay, I have told you that first of all, it requires banks to build up the buffer of capital, of money in good times. So it is pre-announced. RBI usually announces the counter-cyclical capital buffer when the RBI thinks that, okay, in the coming 4-5 months, there can be the problem that can arise. So in the good times, the banks are asked to maintain extra capital so that this can be used during the bad times, okay, during the recessionary situation, let's say. So in the recessionary situation, what is happening, that the demand is low, the prices are low, the production is low. With the low production, there are low profits. With the low profits, what will happen, that the businesses will not have much money to repay the loans that has been taken. So the businesses might start falling. They might start not repaying the loans. Okay, that is, the loans start becoming, more and more loans start becoming non-performing assets. That are, the loans are not coming back, or the interest payments are not coming back. So for this kind of situation, there are the extra buffers that has to be maintained. So if the RBI feels that, okay, there is the recessionary tendency that is going to come in the economy, or there are the problems that are starting in the economy, then the RBI will ask the banks to maintain the extra buffers. Okay, so this is the RBI will ask to maintain the buffers in the good times when the RBI is expecting that in the future the bad times can come. Okay, so during the good times, the banks are asked to maintain the extra buffers, which may be used to maintain the flow of credit to the real sector, to the businesses and such, in the difficult times during the recessionary kind of situation. Secondly, it achieves the broader macro-prudential goal of restricting the banking sector from too much lending. So that also becomes a problem, that if the banks start lending too much, so that also becomes a very big problem, and that's why the RBI can also initiate these buffers. If the RBI feels that there is too much of the credit that is being given by the banks, then the RBI can say that, okay, you have to maintain more buffers. That means you will be able to give less loans as you are keeping more of the money for the buffers. Okay. So excess credit growth is also a problem. Sometimes it can lead to the system-wide risk, because sometimes the banks think that, okay, the economy is working very well and right now much of the credit demand is coming, so let's give the credit very easily without much of the verification. So that becomes problems. That can lead to the system-wide risk. So during that time also, when there is too much of the credit that is being given, the counter-cyclical capital buffer can be initiated by the RBI. Next, maintenance. So what is like the counter-cyclical capital buffers have to be maintained by the bank in what form? So in the most liquid of the assets, that is the CET1, in the form of CET1. So the common equity tier 1, in this form, the banks have to maintain the counter-cyclical capital buffers. Now, counter-cyclical capital buffers is sometimes written as this, and in the previous guidelines, it is written as this. So doesn't matter. You can write it in any form, though prefer this, because this, like in the recent of the notification, the short form has been written in this way. In the previous guidelines, the short form has been written in this way. Okay, doesn't matter much because they both mean the same. So, okay. So the banks have to maintain the counter-cyclical capital buffers in the form of the CET1, that is the common equity tier 1, that is the most liquid kind of capital that has to be maintained under the counter-cyclical capital buffers. Okay. Now this may vary from 0% to 2.5%. So 0% when there is not the requirement of the counter-cyclical capital buffer. 2.5% is the highest. That can be maintained when there is the most highest kind of risk that is coming in the country. Okay. So the CC, that is counter-cyclical capital buffers, may be maintained in the form of common equity tier 1 for absorbing the loss, that can fully absorb the loss, and the amount of the CCCB may vary from 0% to 2.5% of the total risk-weighted asset of the banks. So capital buffers have to be maintained against the risk-weighted assets, always against the loans that have some risk weight attached. Now the counter-cyclical capital buffer decision would normally be pre-announced with a lead time of 4 quarters. 4 quarters. That is nearly a year, you can understand. Okay. However, depending on the indicators, the banks may be advised to build up the requisite buffer in a shorter span of time. So usually it should be 4 quarters that RBI should announce the maintenance of the counter-cyclical capital buffers before the 4 quarters, like lead time of 4 quarters, and in the shorter span of time also the RBI can announce this kind of activation. Okay, now thresholds. When the RBI will say that okay, now there is the need of the counter cyclical capital buffers, so the credit to GDP gap shall be the main indicator in the framework. So the first of all, let's discuss the indicators. Okay, threshold we will understand in the next slide. So the indicators, that what indicates that now is the requirement of the counter cyclical capital buffer. So that is the credit to GDP ratio. Credit to GDP ratio. That means the definition that has been given is credit to GDP credit to GDP ratio is credit divided by the GDP ratio. Let's say the GDP is 1 trillion and the credit that is given is 10 billions. So that means there is too much of the credit that is given against the GDP. Okay, let's say that the credit to GDP ratio has become nearly 50%. That means whatever GDP, whatever production that is happening in our country, out of that 50% is going for the credit. 50% of the money is going for the credit. So that is too much of the amount, and that is of course that is troublesome. So credit to GDP gap is the difference between the credit to GDP ratio and the long-term trend value of the credit to GDP ratio. That is, in the long term, the credit to GDP ratio is going to be maintained at 2.5% or 5%. So that is, the current credit to GDP ratio is too high as compared to the long-term trend. So that is, this is the main indicator, the credit to GDP gap. That is the gap between the current credit to GDP ratio as well as the long-term credit to GDP ratio. Okay, so that is the credit to GDP gap. That is known as the credit to GDP gap. So on the basis of the credit to GDP gap, this is the main indicator in the framework in India. However, it shall not be only reference point and shall be used in conjunction with the GNPA growth, that how much the gross non-performing assets have grown. If they have grown too much, then this credit is actually a problem. If the gross non-performing assets is not growing too much, they are very small percentage, that means whatever credit that the banks are giving, they are giving with the proper verification, and the credit is also coming back. The money, the assets, they have less risk also. Okay, so that is the good credit. So credit to GDP gap with reference to the GNPA growth, in reference to the gross non-performing asset growth. Okay, so credit to GDP gap is the main indicator in the framework in India. It shall be with reference to the GNPA growth. It shall be seen with the reference of GNPA growth, as well as there are also the supplementary indicators such as the incremental, the credit to deposit ratio, that if the credit is growing, the deposits are also growing or not, for a moving period of 3 years in correlation with the credit to GDP gap and GNPA growth. This should also be seen, the credit to deposit ratio. The industry outlook assessment index, maybe the industries are developing very fast and they require the credit very fast. That's why the credit is being required. So you have to see the industry outlook assessment index. If the credit is going for the productive activities, that is good. But if credit is going for the consumption activities only, so that becomes a problem, because the consumption, the demand is increasing very fast, while for the production you are not taking much loans. So that means the production would not be able to increase very fast as investment is not happening much. So industry outlook also has to be seen. The interest coverage ratio also has to be seen, that how much is the interest going for deposit, how much is the interest going for the credit in correlation with the credit to GDP gap. So while taking the final decision on the CCCB, the Reserve Bank of India use many of the indicators on as per the discretion, but the main indicator is credit to GDP gap. You have to remember that. Okay. So CCCB framework shall also have two thresholds, that is the lower threshold and the upper threshold with respect to the credit to GDP gap. Okay. So that is the lower threshold of the credit to GDP gap where the CCCB is activated. So the lower threshold is 3 percentage points, provided its relationship with GNPA remains significant. So let's say the credit is high, the credit is 3% of the GDP. Okay, not 3% we can say. So the credit to GDP is 6%. In the long run, the credit to GDP ratio will be 3%. So the credit to GDP gap is actually 3%. The credit to GDP gap is actually 3%. That means the current ratio is higher as compared to the long-term trend by 3%. So that is the credit to GDP gap. And there is also the high gross non-performing asset growth that is happening. That means the non-performing assets are also growing. So that means there is some trouble that is going to come in the country, because the credit to GDP ratio is also very high in the current period as compared to the long-term trend, as well as the GNPA ratio is also high. So in this scenario, the CCCB can be activated. The upper threshold where the CCCB reaches its maximum. So CCCB will be in between 0% to 2.5%. So the maximum of the counter-cyclical capital buffer will be applied when the credit to GDP gap has reached 15 percentage point. That means, let's say the credit to GDP ratio is 18%. Okay, that is the 15% is the gap. So current credit to GDP ratio is 18% as compared to the long-term trend of 3%. So the gap in between the current and the long-term is 15%. So as soon as the upper threshold reaches its maximum, that is 15 percentage points, the maximum value of the counter-cyclical capital buffer has to be maintained by the banks. Okay, so maximum value of 2.5% of the risk-weighted assets the bank should start maintaining till the time of withdrawal is signaled by the Reserve Bank of India. In between 3 and 15 percentage points, so let's say the gap is near to 3 to 6%, then the counter-cyclical capital buffers will be near to 0% to, let's say, 1%. If the gap is near to 10 to 15%, let's say the counter-cyclical capital buffers will be in between 2% to 2.5%. So that is what is written here, that the counter-cyclical capital buffer will be increased slowly from 0% to 2.5% on the basis of that where the credit to GDP gap is. It is on the lower side or is it on the upper side? So if it is on the upper side, the counter-cyclical capital buffer will also be on the upper side. If the credit to GDP gap is on the lower side, the counter-cyclical capital buffers will be also on the lower side. So that is the idea. Now maintenance for all the banks operating in India, they have to maintain the counter-cyclical capital buffers when it is activated by the Reserve Bank of India on the solo basis as well as on the consolidated basis. That means SBI, PNB, the ICICI Bank, SDFC Bank, they all will have to maintain, if RBI is saying 1% of the counter-cyclical capital buffers, so all the banks will have to maintain 1% of their risk-weighted assets. The extra buffers will have to be maintained as well as accumulating all the banks, then also it should be 1% on average. Okay, so that is the idea, that on the consolidated basis of all the banks as well as on the solo basis also the same percentage has to be maintained. All banks operating in India, let it be the foreign banks, let it be the domestic banks, if it is operating in India, if it has branches in India, they should maintain the capital for Indian operations under the CCCB framework based on their exposure, based on their risk-weighted assets in India. So that is the idea, that is the complete framework and the news article that we have discussed. The news is only that the RBI is not initiating, not activating the counter-cyclical capital buffers. Okay, and the framework also we have discussed. We have discussed the main indicator, what is it, and the overall framework we have discussed. So I hope you can easily answer this question. Yes, consolidated basis means the average counter-cyclical capital buffer of all the banks. Okay, so Tanushri is asking about the lower threshold. Lower threshold means that from here, like if the credit to GDP ratio currently is 5%, in the long term, let's say it is the credit to GDP ratio in the long term should be 3%. That means the credit to GDP gap, the gap is only 2%. So that is fine. This much gap is maintainable. This much gap can be maintained. But if it becomes 3% or higher than 3%, then it can become troublesome for the country, and then RBI will have to see that the credit to GDP gap with reference to the GNPA, that the GNPA, gross non-performing assets, are also increasing. If they are also increasing, then the RBI will have to take the action and will be introducing the capital, the counter-cyclical capital buffers, let's say to 1% or 0.5% or such, because they are near to 3%. Okay, so that is the lower threshold. That means after this, the RBI will have to start introducing the counter-cyclical capital buffer if the credit to GDP gap in relationship with the GNPA is higher than 3%, 3% or higher than 3%. Okay, so lower threshold of the credit to GDP gap where the CCCB is activated by the RBI shall be set at 3 percentage points. Okay, so after the 3 percentage point, or from this 3 percentage points of the credit to GDP gap, the RBI can start with the counter-cyclical capital buffer, provided it has some GNPA growth also that is coming in the country. Okay. No. See, risk-weighted assets are what? Risk-weighted assets. These are the loans that the banks are giving. The risk weight, like how risky the loan is. Okay. So the bank is giving the loan to business, so that has the risk weight of 50%. The bank is giving the loan to state governments, that has the risk weight of 10%. The bank is giving loan to central government, that has the risk weight of 0%. The bank is giving the loan to MSME, that has the risk weight of 80%. So it depends on how much loans the banks have given and the risk weights that are attached to the loans. Out of this, how much capital the banks have to maintain. This capital is decided by the Reserve Bank of India. So 9% is the capital. CRAR, capital to risk weighted asset ratio, plus 2.5% is the capital conservation buffer. So in total, the bank should maintain 11.5%, and the counter cyclical capital buffer can be introduced by the Reserve Bank of India as and when required. Okay, so this is the complete idea. So on the normal basis, the banks have to maintain 11.5% of the capitals against the risk-weighted asset, but the RBI can also introduce the counter-cyclical capital buffer as and when required. So this is the first question. I hope this you can answer. And this is the second question. So this is also a homework question that you have to answer. Okay. Any other question? Purushottam, risk-weighted assets are the loans. Capital is what the banks have to maintain with themselves. Risk-weighted asset is the loan that the bank is giving, and again, like those assets, those loans have some risk weight attached. Okay, against the risk-weighted assets, the banks have to maintain the normal capital. But in the time of need, in the time of problem, the banks will have to maintain higher capital. That will be shown through the counter-cyclical capital buffer, that how much higher capital the banks have to maintain. The banks are on the normal situation maintaining 11.5%, that is 9% plus the plus the capital conservation buffer. So capital, the normal capital, that is 9%, the CRAR, that is 9%, plus the capital conservation buffer, that is 2.5%. Okay, so on the normal situation, the banks have to maintain 11.5% of the capital against the risk weighted assets. But when the time requires, when there is the problem that is coming in the country, or the problem can come in the country, then the RBI can initiate and activate the counter cyclical capital buffer that can be in between the range of 0% to 2.5% on the basis of where the credit to GDP gap is in with reference to the GNPA ratio in the country. So this is the second question. I hope you can easily answer this question also. And there is a big announcement from EduTap that we have brought for you the comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebook, you can get much of the knowledge regarding the examination. Let it be the pattern of the exam, the syllabus of the exam, even the previous year questions you can get with this guidebook. And this is absolutely free of cost to save your time, to save your efforts, and you can easily download this guidebook. The link is provided in the description box below. Okay, so this is it for today. I hope you have understood the news article. If there is any confusion, you can also comment down below regarding your confusion. Okay, you are most welcome Nitya, you are most welcome Nilesh, you are most welcome Ayush. Thank you for attending the session, and you can also call us here or you can mail us here. Okay, so thank you everyone. Thank you for joining the session.